Hello everyone, welcome to today's US Open live webinar. It is Thursday, March 9th, 14:20 GMT, 10 minutes before Wall Street opens. This is your host, Nikos Zabouras, Senior Market Specialist at FXCM. So this is quite a busy week. We have some major events already happened and expect more tomorrow. Obviously, Chair Powell's Congress hearing was the main event, which happened on Tuesday and Wednesday, and we have the upcoming NFPs. There were some other things that we're also going to talk about, but before we delve into it, as always, please read carefully through the disclaimers and the risk warnings, and then we will get started. Okay, let's go ahead and get started as we look at Euro USD. Obviously, we said that Chair Powell's Congress testimony was the main event and had quite a significant impact on market and market pricing around the Fed's policy path. But before we talk more about that, and of course the outlook of Euro USD and other assets, let's get a few other things out of the way first. Just early today, we had a US weekly jobless claims, which actually rose to 211K after a few significant declines that sort of helps Wall Street a little bit. Also today, we had China's CPI inflation, which is to 1% year over year, and this is the lowest level in around a year, while Japan's final Q4 GDP grew by 0.1%. Now, on Wednesday, we also had the Bank of Canada, which became the first major central bank to pause its rate hike cycle, in line, of course, with its previous and recent guidance. The BOC did so after having raised rates by 400 basis points to 4.5%, and the highest level since 2007, in a process that started roughly a year ago. However, it did warn again that it is prepared to increase rates again if necessary based on the incoming data. Okay, so that's that, and now let's delve into Chair Powell's testimony, which the first one was on Tuesday in the Senate, and the second one was on Wednesday in the House. Of course, the first one was where we got most of the important stuff. So, if you remember back at our last session, we had talked about how Chair Powell could potentially adopt a more reserved, a somewhat reserved stance, given the fact that there are important looming economic releases, but also that there was grounds for a more hawkish stance and a move away from the disinflationary narrative that we had seen from Mr. Powell, given that PCE readings have shown an acceleration in inflation based on the most recent data. And Mr. Powell was definitely more aggressive this time around compared to his previous speeches, as he spoke of a likely higher terminal rate than previously anticipated due to the better than expected data. More to it, he warned of faster tightening if data continue to come in hot, essentially opening the door to an acceleration in the pace of rate increases. It is also worth noting that these comments were part of his opening remarks. It wasn't like he was specifically asked about or he was pressured into giving a specific response. Now, we need to note though also that in his second hearing on Wednesday, he sort of walked that back a little bit by saying that we have not made, and I quote here, we have not made any decision about the March meeting. In any case, the commentary by Chair Powell was definitely more aggressive and more forceful compared to his previous remarks last month. Led to another market repricing around the Fed's policy path. CME's Fed Watch tool now assigns the highest probability to a 50 basis points hike in the upcoming meeting, that's in 2 weeks, from 0.25% previously, and also assigns the highest probability to a terminal rate of 5.75%, a full percentage point above the current rate. So that's it from Mr. Powell's speech, and of course, markets reacted since this reinforced the higher for long narrative, and market pricing adjusted in line with that, and we saw Euro USD dropping on Tuesday, posting its worst day of the year. And let's switch. We're watching here the hourly chart, but let's switch to the 4-hour for our technical analysis. So it moved back below the daily Ichimoku cloud, which we had warned on our session on Tuesday about. It is now exposed to the critical 1.0451, 1.40 region, this one here, but bears will need help from the incoming data if they are to break below it, we believe. And in any case, sustained weakness past this area may prove elusive, because the ECB is also on a very aggressive tightening path and has clearly communicated its intention to hike by another 0.5% at the upcoming meeting, and various officials have, including the president, have also hinted to more moves after that. So yes, we could see further drop, but it's not so easy to see sustained weakness between this area we highlighted here. Now, the common currency, however, rebounds today. We can see here that it's on the day, and as such, it could try to reclaim the 200-period EMA roughly at around 1.0670, 1.0690, but at this stage, it does not inspire much confidence for a bigger advance that will allow it to break above the upper border of the cloud at around 1.0820, 1.0840. So again, we need to say that the trajectory will not only of Euro USD but of the other assets that we'll talk about will depend on the NFPs Friday, the inflation update next Tuesday, and then of course on the 22nd we have the actual policy decision by the Fed. Now let's move on to USD JPY. Which strengthened after Chair Powell's speech and the relevant repricing in markets, and set fresh 2023 highs yesterday as markets digested those comments, although we can see a steep decline today. And again, the trajectory will be determined by the factors we mentioned above, but also we have on Friday before the NFPs, as Japan is far ahead in the time zone. We expect the policy meeting by the Central Bank of Japan, the Bank of Japan, the BOJ, Now, we will talk about that at our last segment, as always, about the upcoming events. So today's losses create some scope for further pressure towards this critical region here, 134.70, 134.20, where we have again the daily move cloud and the 200-period EMA. Now, unless the incoming data dictates such a move, we struggle to see sustained weakness below this level, and then mid 130s look distant. Again, we wouldn't rule out pressure to this region, but even that we need some catalyst. Bulls are clearly in control of the states, held by the policy differential, and can post higher highs towards 139.39 to 139.58, but it may be early to talk about further advance past these levels. Now, again, we have two critical events tomorrow that would spread volatility and determine the next leg of the move. And as we're already 1 minute into the year session, let's switch gears and talk about the Nasdaq. You can see here Nas 100 benefits at this stage. These are from the rise in unemployment claims, but overall it's been subdued. It is weighed again by Chair Powell's comments. We said how these have reinforced the higher for longer prospects and the relevant adjustments in market pricing. These are all headwinds for the tech-heavy index and create risk for fresh lows towards 18,110. But again, a catalyst would be needed for further declines that would challenge the broader 11,500 region, for which we have talked about again. Now, despite these factors that we talked about, the Nasdaq is resilient. Now, we need to remind that the pricing and market expectation occurred right after the last NFP report at the beginning of February, and was reinforced, of course, later on. Back then, before the last NFPs, markets were pricing just 25 basis points of hikes. Now they're pricing a full percentage point. In this period, Nas 100 has lost around 3%. So we think that this is quite significant resilience. We can see that it found support yesterday, tries to stay constructive today and above the 200-period EMA, but immediate bias is on the upside, and the index will have could have the opportunity for new weekly highs around 12,500, but we're cautious about sustained strength past 12,900 given the unfavorable monetary policy outlook, as things, of course, stand now. Now that's it for the technical outlook, and let's focus on what's ahead. As we already said, we have the US jobs report coming up on Friday. The previous one had shown the creation of more than 500,000 jobs on January and dropping unemployment to 3.4% and the lowest level since 1969. And it had sparked this market repricing that we talked about, which of course was reinforced later on mainstream data points. Now, expectations from what we see on the economic calendars are for the additions of around 200,000 jobs this time, and we think that even though it would be significantly less than the previous figure, it would still support the tight labor market narrative. We also need to take note of the fact that the US jobs report comes on the final day before the communication blackout period. So it will be interesting to see if officials will scramble to make some commentary, or if they will wait, given the fact that a few days later on Tuesday we also expect the CPI inflation report. Now, also on Friday, ahead of the NFPs, as we said, we expect the Bank of Japan. This is the last policy decision with Governor Kuroda at the helm of the bank, as he steps down in early April. Looks like, from what we have seen, that we're going towards a seamless transition that would maintain the status quo. So this may turn out to be a non-event, but on the other hand, the Bank of Japan has surprised before, mostly last December, a few months back, when it had widened yield curve control, taking markets by surprise. Other than that, tomorrow we expect some data from UK and Germany, and also Canada's employment figures. On Tuesday, we already said, and right before our next session, US February CPI inflation data are due. In January, both headline and core CPI had eased, but both were hotter than expected, while the more recent PCE report showed a reacceleration of inflation. Also, bear in mind that time changes in the US over the weekend, so we will adjust the time of this US Open live webinar in order to still start 10 minutes before Wall Street opens. That's it from me for today. We will talk again on Tuesday. Thank you for joining.